If you're a tax professional who works with military veterans, I'm sure you've seen this before. You get a Form 1099-R and something just feels off. Well, today we are doing a complete technical deep dive into this really complex but absolutely critical issue, reconciling military retired pay after a veteran gets a retroactive VA disability award. Think of this as your guide to navigating all the rules and getting your clients the significant refunds they've rightfully earned. Okay, so let's just jump right into this central paradox. It's a weird situation, right? It all comes from this administrative gap between two enormous government agencies. You've got the Department of Defense, the DoD, which is cutting the checks, and then you have the Department of Veterans Affairs, or VA, which decides on disability status. Understanding this disconnect is really the first major step to fixing the tax return. So here's our game plan. First, we'll nail down the exact source of this 1099-R headache. Then, we're going to build our case from the ground up, starting with the law, the statutory framework, and the landmark court case that gives us the authority to even make these changes. After that, we'll get into the real nuts and bolts, the step-by-step procedural guide, some special timing rules you absolutely have to know, and finally, how to untangle the very tricky issue of concurrent receipt. Let's start with the why. Why does your client have a Form 1099-R showing all this taxable income when it shouldn't be? And more importantly, why does the responsibility to fix it fall squarely on your shoulders? Okay, so here's the administrative reality that's at the very heart of this problem. The Defense Finance and Accounting Service, DFAS, they report the cash that was actually paid out during a given year. That's their job. So when the VA comes along later and retroactively changes the character of that pay, DFAS does not go back in time and amend old 1099-Rs. This leaves your client holding an official document that overstates their taxable income, and well, the burden to fix that mistake falls entirely on them and, by extension, on you. All right, now let's build the legal foundation for our adjustment. To confidently go in and amend a return, we need to ground our entire argument in the Internal Revenue Code itself. We're going to move from the broad definition of income to the very specific exclusion that makes all of this possible. The code always starts with a really wide net. Internal Revenue Code Section 61A basically says that military retired pay, which is based on length of service, is just a form of deferred compensation. So by default, it's fully taxable ordinary income. This is exactly why DFAS reports the entire amount as taxable in Box 2A of the 1099-R. The whole system just presumes it's taxable from the get-go. And here it is. This is our specific statutory authority for the whole exclusion. IRC Section 104A4 explicitly carves out an exception for payments that are received for personal injuries or sickness from active military service. This is the legal switch that flips that income from taxable to non-taxable. But, of course, it's not quite that simple. Congress went and narrowed this exclusion back in 1976 with Section 104B. It created two conditions. Now, the combat-related injury rule is pretty straightforward, but you really need to pay close attention to that second one, that little clause, the one that says the individual would be entitled to receive disability compensation from the Department of Veterans Affairs. That right there is the absolute linchpin for every single adjustment we're talking about today. So we have the law, but how does this statutory framework actually hold up in practice? Let's take a look at the landmark court ruling that underpins our entire argument. Because this isn't just some IRS allowance, it's a right that was established by federal case law, and it gives us clear authority to retroactively reclassify this income. This slide really gets to the core legal principle that was established in Strickland v. Commissioner. The Fourth Circuit basically ruled that a retroactive VA determination effectively rewrites the history of those past payments. So even though the money was initially paid out and labeled as taxable retirement pay, the court found that the veteran's legal entitlement was actually to non-taxable disability pay all along. The key takeaway is this: the tax character follows the entitlement, not the original label slapped on it by an administrator. And other cases have built on this foundation over the years. St. Clair took the principle and expanded it to cover lump sum severance payments. And more recently, the Valentine case set a really crucial boundary. It clarified that this adjustment is a specific dollar-for-dollar substitution based on the VA waiver. It's not some broad percentage-based exclusion of the entire pension. That's a key detail. Okay, let's dive into the how, the operational mechanics of this. We've got the statutory authority, we've got the judicial precedent. Now we need the specific playbook from the IRS itself on how to translate all this theory into a properly filed amended return. This single sentence, which you can find directly in IRS Publication 525 under Military and Government Disability Pensions, is your explicit regulatory authorization. The IRS is telling you in plain language that you are absolutely permitted to make this adjustment. It acknowledges the recharacterization and it sets the cap for the exclusion. It's a dollar-for-dollar match to the VA disability benefit and no more. So when you're filing that Form 1040X, the amended return, you need absolute precision. You'll put the original adjusted gross income, the AGI, in column A. Then the specific excludable amount for that tax year goes in column B as a negative number, which gives you the corrected AGI in column C. But honestly, the most critical parts of the whole filing are the narrative explanation you write in Part 3 and the non-negotiable attachments that prove your claim. It is so essential to use precise, authority-backed language in your Part 3 explanation. I mean, don't just paraphrase this. Think about the power of these words. When you cite the case law like Strickland, the relevant revenue ruling, and the specific code section, you're showing the IRS examiner that you've built a legally sound case, and you're not just making some random adjustment. It's all about speaking their language to ensure this thing processes smoothly. Now for a really critical practice point to help you avoid processing errors. Here's a bit of insider knowledge for you. If you do a rigorous review of Publication 525, you'll see the acronym ISO is used exclusively to refer to incentive stock options. Do not use this term when you're describing a VA disability offset. Using the wrong terminology risks having the entire adjustment miscategorized by the IRS, and that just leads to unnecessary notices and long delays. Okay, so one of the biggest challenges here is that VA disability adjudications can take years. I mean, years, often blowing right past the standard 3-year statute of limitations for filing an amended return. Recognizing this, Congress actually created a special rule, IRC Section 6511D8, to give veterans an extended window to claim these refunds. And here's the key provision. Under IRC Section 6511D8, that standard 3-year clock becomes totally irrelevant. Instead, your client gets 1 full year, 1 entire year, from the date on the VA's determination letter to file a refund claim for all eligible prior years. This is such a powerful and often overlooked provision that can unlock refunds that would otherwise be completely lost to time. Let's just walk through how this rule works in practice. So imagine the VA issues a letter on September 10th, 2025. That starts a 1-year clock, giving the veteran until September 10th, 2026 to file all their claims. Now, the rule lets you look back 5 years from that determination date, and it applies to any tax year that began within that 5-year window. So in our example here, 2020 through 2024 are wide open for refunds, but 2019, which began more than 5 years prior, is unfortunately time-barred. Now for our final area of complexity, and this is important. It's crucial to understand that not all 1099-Rs that look a little high are actually incorrect. We have to account for these things called concurrent receipt programs, which can legally restore taxable pay to a veteran's check. This table right here highlights the critical distinction between the two main concurrent receipt programs. You'll want to pay close attention to this because it's a super common point of confusion. So, concurrent retirement and disability pay, or CRDP, that's a restoration of taxable retired pay. It is not excludable through a Strickland adjustment. In contrast, you have combat-related special compensation, or CRSC, and that is non-taxable. So a retroactive award of CRSC can generate a refund. So to summarize our whole technical deep dive here, first, remember that DFAS is not going to fix the 1099-R, so the burden is on you. Second, your legal authority is rock solid, flowing right from the Internal Revenue Code and the Strickland case. Third, your procedure has to be precise. Use the right language on the 1040X, and always attach the VA letter. Fourth, be vigilant about that special 1-year deadline under 6511D8. And finally, always differentiate between taxable CRDP and non-taxable CRSC before you even start. And this brings us to a final and, I think, crucial question. These administrative delays, they're systemic. They're just part of how things work. So what this explainer has given you are the technical tools, the procedural playbook, and the specific legal authority to investigate that question for your own clients and to make sure they get every single tax benefit they have earned through their service.